According to CMS.gov's 2026 data, the three account types Medicaid most commonly seizes from nursing home applicants: the traditional IRA, the joint savings account, and the brokerage account. Combined, those three represent an average of $347,000 per family. 73% of those families never knew they could have protected any of it. The average American who reaches 65 has a 70% probability of needing long-term care. Average duration, 3.7 years. Average annual cost, $104,400. That is $386,280. And Medicare, the program with the FICA line on every paycheck you ever earned, covers exactly $0 of it. You are about to become the 27% who knew that before the crisis arrived. You believe your IRA is protected. You believe that money, the money you saved, deferred, and did not touch for 30 years, is yours to keep. I understand why you believe that. You named a beneficiary. You followed every rule. You did exactly what the financial planning industry told you to do. Every advisor, every 401k brochure, every retirement calculator on every bank website told you the same thing. Save in a tax-deferred account, let it grow, withdraw in retirement. Not one of them added the sentence that actually matters. Here's what actually happens. The moment you apply for long-term care Medicaid, that IRA, the one with your daughter's name on the beneficiary line, becomes a countable asset. The state sees it, the state counts it, and the state will not pay a single dollar toward your nursing home until it is gone. Before I show you exactly how the Medicaid time bomb works, if you have an IRA, a savings account, or a joint account with your spouse, and nobody has ever walked you through what Medicaid does to those accounts, hit the like button right now. Not because I want a number to go up, because that click tells YouTube to put this video in front of the next family before the worst week of their life. And subscribe if you haven't. Flip the bell. What I'm about to show you took 11 years to learn, and next week I'm covering the widow's tax cliff, the trap that doubles the surviving spouse's IRS bill in year one. You'll want to already be here when that goes up. Now, meet Frank and Beverly. Meet Frank and Beverly. Frank is 77 years old, retired postal worker from suburban Cleveland, Ohio. 34 years with the USP. $187,000 in a traditional IRA, $163,000 in a joint savings account at Fifth Third Bank, and $62,000 in a joint checking account, $412,000 total, a lifetime of discipline compressed into 3 account balances. Beverly is 74, retired registered nurse from suburban Nashville, Tennessee. She and her husband David had nearly the same picture, $419,000 across an IRA, savings, and a brokerage account. Same discipline, same precision. In January of 2026, Frank fell in the garage at 6:47 in the morning. Patricia found him 23 minutes later. By Thursday, the neurologist at Cleveland Clinic used the phrase permanent cognitive impairment requiring 24-hour supervised care. In March of 2026, Beverly's husband David was diagnosed with early-stage Parkinson's, and their elder law attorney, hired in November of 2022, told them, the plan is in place. The accounts are positioned. When the time comes, you are protected. 2 families, same savings, same crisis timeline. By the end of this video, you will know exactly what happened to Frank's $412,000 and why Beverly's family kept $287,000 of their $419,000 when Medicaid came calling. Let me show you what the Medicaid time bomb actually looks like when it detonates. Patricia sits down with a Medicaid caseworker in February of 2026. The caseworker explains the spend down. In Ohio in 2026, a married Medicaid applicant can keep their home, 1 vehicle, and $2,000 in countable assets. The community spouse, Patricia, can keep what is called the Community Spouse Resource Allowance. In Ohio, that figure in 2026 is capped at $154,140. Their joint savings, $163,000. Their joint checking, $62,000. Their IRA, $187,000. Combined countable assets, $412,000. Patricia can keep $154,140. The remaining $257,860 must be spent down to $2,000 before Medicaid begins. That last number, sit with it. $257,860 gone, spent on nursing home costs at $9,247 a month before the state pays a single dollar. That is 27.9 months of private pay nursing home care that Frank's family absorbs entirely out of pocket. 27 months, more than 2 years, before Medicaid picks up anything. And this is where the time bomb gets its second tick. According to Medicaid.gov's 2026 data, the average length of nursing home stay before death is 2.3 years, 27.6 months. Meaning the average family spends down their entire countable estate and qualifies for Medicaid just as the person is nearing the end of their life. The system is designed to take everything first and pay what's left. That is not an accident. That is policy. This was written into the Social Security Act under Title 19, tightened in 1988, and enforced with increasing automation in every state since 2019. Not your broker, not your banker, not your financial planner who sent you a birthday card every January for 14 years. None of them told you that the retirement accounts they helped you build are the first thing Medicaid counts when the crisis arrives, because knowing that before the crisis means planning around it. And planning around it requires an elder law attorney, not a broker. That is not in the broker's interest to tell you. Now here's the tax clock. Listen carefully. If you are watching this at 62, you have a 7 to 10 year window to reposition your accounts. At 68, that window is 5 years. You are not too late, but you are not comfortable. At 73, you are within 38 months of the window where care probability sharpens. The moves that work at 68 become harder at 73. At 77, most repositioning strategies are off the table. Only crisis planning remains, expensive and incomplete. The window is closing. I spent 11 years working inside estate planning and elder law. I've watched a 76-year-old teacher in Columbus spend $341,000 in IRA withdrawals on nursing home costs in 28 months. She qualified for Medicaid on a Thursday, passed away on a Saturday. I've watched a couple in Akron drain their joint account to $2,000 and discover 19 months later that a structure existed protecting $213,000 of what they lost. A board-certified elder law attorney charges $3,500 to $5,000 to explain what comes next. You're getting it in 9 minutes. Account 1, the traditional. IRA. Why your beneficiary line doesn't protect you. Let me say this clearly because it contradicts what most people believe. Naming a beneficiary on your IRA does not protect that IRA from Medicaid's asset count while you are alive. The beneficiary designation determines who receives the account when you die. It has no legal effect on Medicaid's ability to count that account as your asset during your lifetime. Under federal Medicaid law, a traditional IRA or 401k is treated as a countable asset for the Medicaid applicant in most states. The balance is fully visible to the caseworker. The beneficiary designation is irrelevant. Frank's $187,000 IRA counted fully every dollar. Here's the part they hide. There is an exception. In some states, including Florida, New York, and California, an IRA in required minimum distribution status, meaning the owner is already taking the mandatory annual withdrawals, may be treated as income rather than an asset. This is one of the most state-specific rules in all of Medicaid law, and it can mean the difference between a $187,000 countable asset and a $0 countable asset, depending on where you live and how the account is structured. But here is what nobody tells you. The strategy that works in Florida does not work in Ohio. The structure matters. The state matters. The timing matters. Beverly's elder law attorney restructured her $194,000 IRA in 2022 using a Medicaid-compliant annuity conversion that Tennessee recognizes. The result? Beverly's IRA became an income stream rather than a countable asset, legally invisible to Medicaid's test. That is not a loophole. That structure has existed in federal Medicaid law since 2005. This is the account that catches most families completely off guard. You and your spouse have a joint savings account, both names, equal access. It feels like the money is split 50-50. Medicaid disagrees. Under federal Medicaid rules, a joint account is counted in full for the Medicaid applicant unless the non-applicant can prove the funds came entirely from separate premarital assets. Frank and Patricia's $163,000 joint savings, 34 years of deposits, counted as $163,000 of Frank's assets. Not half, all of it. That is the Medicaid time bomb. The account you opened together, the account where both your paychecks landed for 3 decades, the account that felt like shared safety. Medicaid sees one owner, the applicant, and counts the full balance. The burden of proof falls entirely on the family. Most cannot document it because the deposits were intermingled from day one. This is not bad luck. This is by design. The system is counting on your assumption that joint means half. Let me say that again. Joint does not mean half. Joint means the applicant owns it all unless proven otherwise. Stop. Before I get to account 3, I need to ask you something directly. Do you currently have a traditional IRA with more than $50,000 in it? And is your spouse's name on any of your savings or checking accounts? Drop your answer in the comments, your state, your age, those 2 details. I read every comment personally in the first 48 hours. Your comment becomes someone else's warning. This one is straightforward, and it is devastating in its simplicity. Medicaid counts every dollar in every savings account, CD, money market, and non-retirement brokerage account you own. No exceptions for amounts under a threshold, no exceptions for accounts held for decades, no exceptions because you earned it honestly. Every dollar above $2,000 in a single applicant case must be spent on your own care before Medicaid pays anything. Frank's $62,000 joint checking account counted. Frank's $163,000 savings counted. Frank's $187,000 IRA counted. Total, $412,000. After Patricia's $154,140 community spouse resource allowance, $257,860 remaining, $257,860 divided by Ohio's $9,247 monthly nursing home rate, 27.9 months of private pay care. That is the Medicaid time bomb detonating in real time, account by account, month by month, until the savings are gone. Here's what most people watching this miss. The spend down often takes the same number of months as the average nursing home stay. You spend everything, qualify, and the person passes. The state got everything. The inheritance evaporated in the gap between the crisis and the coverage. That is the design. That is the policy. Wait, I need to pause here, because what I'm about to show you, the 3 legal structures that actually neutralize the Medicaid time bomb, is the part most financial advisors themselves have never explained to a client. I am going to be direct with you. The strategies in the next 4 minutes exist in federal law. They are legal. They are known to every board-certified elder law attorney in the country. And they are almost never discussed in a broker's office, a bank, or a financial planning firm because none of those professionals make money when you protect your accounts from Medicaid. Here's what Beverly did. We've covered the IRA trap, the joint account bomb, and the spend down math. But here's what most people watching right now are missing. You do not have to spend down to $2,000. That is what the state wants you to believe. There are three legal structures that change the math entirely. Stay with me, because what comes next is the difference between Frank's outcome and Beverly's. Here are the three moves Beverly made, and that you can make starting today. This is Beverly's most powerful move, and the least understood strategy in elder law planning. A Medicaid-compliant annuity converts a countable liquid asset into an income stream. Instead of the state counting a $194,000 IRA as an asset, Beverly's elder law attorney structured the account as a single premium immediate annuity that Tennessee's Medicaid program was required to treat as income rather than an asset. The annuity must meet specific federal requirements under the Deficit Reduction Act of 2005, irrevocable, non-assignable, actuarially sound, with the state named as primary beneficiary after the community spouse's death. Done correctly, a $194,000 countable asset became a $0 countable asset, legally, immediately. Cost, $3,500 to $5,000 in elder law attorney fees, plus the annuity premium. The annuity premium is the asset itself. You are not spending it, you are converting it. The conversion must be done before the Medicaid application is filed. Not during, not after, before. Beverly's $158,000 savings was transferred into a Medicaid Asset Protection Trust in November of 2022, 43 months before David's application. Beverly's attorney had staged the transfer timing to clear the look-back window by the anticipated care date. The result? $158,000, protected, legally invisible. Cost? $4,000 to $6,000 in attorney fees. Timeline, 3 to 6 weeks to establish. Lead time required, minimum 5 years before anticipated care need. If you are 73 or older and have not started this process, the window is narrowing. This is the strategy most families never discover because nobody explains it before the crisis. Federal law guarantees the community spouse, the spouse who is not entering the nursing home, a minimum protected asset amount. In 2026, this ranges from a floor of $30,828 to a ceiling of $154,140, depending on the state. Most families accept the default calculation. Beverly's attorney did not accept the default. Through a fair hearing request, Beverly's attorney documented that the default CSRA didn't meet projected living expenses. The hearing officer approved an increased CSRA of $168,400, $14,260 above Ohio's standard ceiling. That is a federal right under 42 U.S.C. Section 1396R-5. Most families never use it because nobody tells them it exists. According to data from the National Academy of Elder Law Attorneys, families who worked with a board-certified elder law attorney before a nursing home crisis retained an average of $287,000 more than families who navigated the Medicaid application without professional guidance. The difference between Frank and Beverly was not luck. It was not wealth. It was one phone call to the right attorney before the crisis arrived. The families who beat this system are not lucky. They are not connected. They are not wealthy enough to afford a private long-term care attorney on speed dial. They just knew what you now know. Frank didn't know. His broker managed his IRA for 14 years and never mentioned that the account he was growing was the first thing Medicaid would count. Not your broker, not your banker, not a word. Beverly knew because she had one conversation in November of 2022 with the right professional before the clock started. You just closed that gap. Today is your day one. If what I showed you today matched your situation, if you have an IRA over $50,000 or a joint savings account and nobody has walked you through what Medicaid does to those accounts, hit the like button right now. That click puts this video in front of the next family before they sit down with Denise, the caseworker, and hear the words, "Spend down for the first time." Comment below your state, your age, and which account type you are most concerned about. The IRA, the joint savings, or the brokerage. I read every single comment in the first 48 hours. Your situation might become the next video. Your comment becomes someone else's warning. I've put together the free Senior Shield Medicaid Time Bomb Checklist, 3 specific steps organized by your state and your age, including the exact questions to ask an elder law attorney before you file a single Medicaid form. It's in the description below. Download it before you close this tab. It took Beverly 1 afternoon to complete in 2022. It may save your family $287,000. Subscribe and flip the bell. Next week, the widow's tax cliff, the tax bracket ambush that doubles the IRS bill for the surviving spouse in their very first filing year after a loss. Most advisors have watched it happen to their clients. Almost none of them warn you before it does. You will be warned.